Good morning. I'm Tracy Gordon, Vice President of Tax Policy at the Urban Institute and Co-Director of the Urban-Brookings Tax Policy Center. It's my pleasure to welcome you to International Spillovers in Tax, our 5th annual conference with the University of North Carolina Tax Center. Before we get started, some housekeeping. This event is being recorded and the recording will be posted online afterward. Speaker biographies are also available online. You can hide captions or adjust settings in Zoom using the live transcript button. All participants are muted, but please type questions or comments in the Q&A box at any time. Please take a few moments at the end of the conference to complete the survey. And please also feel free to engage with us online using the hashtag #live@urban. We live in an increasingly interconnected world. A taxpayer can live in the United States, but earn investment income from a good or service produced in the United Kingdom and ultimately consumed in France. Which country should be able to tax which components of that income and why? Say that factory in the UK emits a lot of harmful greenhouse gas emissions in its production process. The UK actually has a robust carbon pricing regime, but what if it didn't? Should other countries impose tariffs on goods imported from the UK to level the playing field with their domestic industries who may be subject to carbon taxes? How? These are the questions this conference was designed to address, and the timing is apt. Last fall, 137 countries signed on to a landmark OECD G20 agreement for the first time to tax large multinational corporations, at least in part, based on where their goods were consumed, and to limit potentially harmful tax competition through a global minimum tax. But now implementation of that agreement has been delayed at least a year, despite ongoing challenges from the rising share of corporate profits from patents, trademarks, and other intellectual property, and the ease of shifting those profits to low tax jurisdictions. What will happen to the OECD G20 agreement? What's next for the US's own global minimum tax? And what's next for carbon taxes as the risks of unchecked fossil fuel use become more and more apparent? We couldn't ask for a better set of speakers on these and other issues. We are especially fortunate to have a keynote address from Rosanne Altshuler. Many of you know Rosanne from her prolific scholarship, public service, and leadership in the tax community. Rosanne is currently a professor of economics at Rutgers University, where she has previously been Dean of Social and Behavioral Sciences and Chair of the Economics Department. Before that, we were fortunate to have Rosanne as co-director and director of the Tax Policy Center, where she continues to serve on our advisory board. Rosanne is passionate about connecting research to policy, finding solutions, and engaging new audiences. It is notable that when she served as senior economist to the 2005 President's Advisory Panel on Federal Tax Reform, the panel reached bipartisan agreement, a rare outcome in Washington, and it included cartoons in its final report. Rosanne has testified many times in Congress, appeared widely in the media, and written on many issues in international tax, often with another tax legend, Treasury's Harry Gruber. Rosanne was a pioneer in using administrative tax data to uncover complex interactions in the tax code and significant gaps between statutory and effective tax rates, sometimes even negative effective tax rates for the R&E tax credit. Finally, as noted when she received the National Tax Association's highest award, the Holland Medal, last year, she has performed, quote, more tasks for and received more honors from the NTA than anyone, unquote. This includes serving as president, editor of the National Tax Journal, and now one of only 37 people over 114 years, and the first woman to be granted distinguished honorary member status. Thank you for all your contributions to tax policy, Rosanne, and thank you for joining us today. We look forward to your comments.
Well, thanks so much for inviting me to give this keynote speech and to open this interesting and timely event. And also thank you, Tracy, for your really too kind introduction. That was very, very nice. I want to start by commending Tax Policy Center for collaborating with the UNC Tax Center. Good tax policy analysis requires bringing all of us that work together on tax issues, including those from many, many disciplines. Accountants and lawyers have been absolutely instrumental to my work over the years. As we know, economists are good at building models and understanding how changes in incentives may affect behavior. We're also good at using data to estimate the extent to which economic agents actually respond to policies, which is key to understanding the cost to the economy of different tax policies. But we absolutely cannot get it right without accountants and without lawyers. And we have everybody on this panel today. So good work, Tax Policy Center. Keep up these connections. Now, in her invitation to me, Thornton suggested that I might discuss how my prior research can inform the topics for today's event. And I thought that really would be extremely indulgent. But after pondering a bit, I decided it might be fun to talk a little about what I've learned through my research and its relevance for today. So let me go to the slides. So, okay, let me just move this view over so I can see my slides. Sorry about that. So there you see the title of the talk, and it really is going to be all about the details matter. The devil is in the details. So let me start by noting that we're on the cusp of historic changes in international taxation. Tracy already mentioned this. 137 jurisdictions have agreed to the OECD G20 Inclusive Framework's two-pillar solution. So in a nutshell, Pillar 1 reallocates certain amounts of taxable income of large multinationals to market jurisdictions where they have customers. And Pillar 2 is a global anti-base erosion regime, which is designed to ensure that large multinationals pay a minimum tax of 15%, regardless of where their headquarters or the jurisdiction they operate in. So this really is historic. In her statement on the agreement, Treasury Secretary Janet Yellen said, as of this morning, virtually the entire global economy has decided to end the race to the bottom on corporate taxation. So a question for policy analysts to ponder, I think, is whether existing research can help us predict whether the historic agreement will be a game changer in the race to the bottom. So I came up with two themes to hit on when thinking about that question. The first theme is that details matter and complicate tax incentives. The second is the importance of understanding what Harry Grubert and I called the three parties in the race to the bottom: host countries, home countries, and multinational corporations. I think both themes of my talk are relevant when thinking about international tax policy spillovers. And the question is, can I tie these things together? I think I can. So let me start by talking about tax law asymmetries. My dissertation was on tax losses. And of course, if gains and losses are not treated symmetrically by the tax code. If they were, there really wouldn't be much to talk about. They're not. Gains are fully taxed, but under current law, losses are carried forward to offset future taxable income. So they're not fully refundable. They can be carried forward indefinitely, but without interest. So again, they're not fully refundable. The treatment of tax losses, by the way, has changed over time, which is interesting in itself. Very little research has focused on how differences in tax law provisions or changes to tax law provisions impact investment and financial decisions of firms. So why not treat gains and losses symmetrically? Well, here the government is trying to thread a needle between not discouraging risk-taking, which could lead to losses, while at the same time not encouraging losers and fake costs, expenses that weren't made or disguised as employee compensation. So there are policy reasons for this asymmetric treatment. But what's really important here is that you end up with this asymmetric taxation. You end up with firms facing different incentives based on their loss position. So due to asymmetric taxation, businesses investing in risky projects for which the probability of having to carry losses forward is positive can expect to pay higher taxes than they would under a system that provides an immediate refund of tax losses. For example, bonus depreciation is going to provide very little in the way of investment incentives for firms that are deep in loss carry forward positions. And the effectiveness of tax credits is intimately related to a firm's loss position. If you have no loss, no tax liability to offset, a credit can't really provide any bang for the buck. And what's important is that a firm's effective marginal tax rate depends on its loss position. Alan Auerbach and I, using data from corporate tax returns from Treasury, found that the effective statutory rate was 2/3 the actual statutory rate at the time. So this estimate is important for understanding how both investment and financing incentives depend on a firm's loss carry forward position. The tax advantage of borrowing, of course, is a function of the firm's effective tax rate. Now, importantly for international taxation, you've all been waiting for this, the incentive to engage in income shifting depends on differences in statutory rates. So it seems that we should be taking actual effective statutory rates into account when we measure income shifting incentives. And this is especially relevant if multinationals go into and out of loss positions. This would mean, in fact, if the effective actual statutory rate that firms are facing is lower than the statutory rate, then it would mean that income shifting incentives may not be as strong as differences in the actual statutory rates suggest. So it's important to note that firms with losses may not benefit fully from tax credits, and also that the details matter for tax credits. And a great example is the R&E tax credit. Congress attempted, when they put the R&E tax credit into effect in 1981, to just incentivize increased research expenditures. So the credit was given on any amount by which your expenditures exceeded a 3-year moving average of past research expenditures. And again, the details here mattered. I found that the incremental structure resulted in an average effective credit rate that was well below the statutory rate. So this was just kind of my introduction, talking a little bit about asymmetric taxation and losses and how that matters and how the details matter. But what about international? Well, here, obviously, what I want to talk about is the foreign tax credit. So the foreign tax credit, which we still have, creates a system in which your incentive to invest abroad and other behavioral margins faced by a firm depends on your credit position. So the foreign tax credit, it turns out, creates a system in which your incentive, I just said that already, sorry. Before the Tax Cuts and Jobs Act made changes to our system for taxing international income, firms were taxed on their worldwide income with a credit called the foreign tax credit for taxes paid abroad on foreign source income. So importantly, income from active business operations abroad was only taxed by the U.S. Treasury when it was sent home, when it was repatriated to the United States. So under the system, incentives differed based on foreign tax credit positions. If you were in excess limitation, roughly speaking, this means that the U.S. tax applied to your foreign source income was higher than your foreign tax burden. You faced the host country tax rate plus the burden of the repatriation tax when you invested abroad. But if you were in an excess credit situation, you were basically subject to a territorial tax system. So you were only taxed on what you earned in the United States, not what you earned abroad. And in fact, as we pointed out in our work, it was better than territorial, as any royalties paid to the US parent from a subsidiary were deductible abroad, but offset by excess credits at home, so not subject to tax in the United States. This created a tax incentive to exploit international property like a patent for a new computer chip abroad rather than the United States, since the returns would escape US taxation. Understanding this was instrumental to understanding the impact of different reforms to the international tax system. And so, for instance, looking at credit positions, knowing the frequency of excess credits was and still is an important part of our analysis. My work with Harry Gruber considered lots of changes to what was the system at the time, a burden neutral worldwide system, territorial taxation, formulaic apportionment, and minimum taxes. And I just want to share a little bit of that with you today. So again, just to stress the importance of understanding how important details are. So burden neutral worldwide taxation would eliminate deferral while keeping current at the time US tax burden on foreign source income constant. So what we did is we got rid of deferral and taxed all US income currently, all foreign source income currently. So of course that would reduce competitiveness of our firms if it wasn't paired with a reduction in rates. And the burden neutral rate at the time was 28%. So what did we find? Well, what we found was that under the new system in which there would be a tax, worldwide income would be taxed currently, how that affected firms depended on whether or not they would have excess credits in the new system. So just briefly, there'd be no efficiency loss associated with repatriation if you were in excess limit, no incentive to engage in income shifting, the effective tax rate for tangible and intangible assets wouldn't vary across locations, all great things. Tax considerations wouldn't affect financing decisions, the tax system would be simpler and less wasteful. But wait a minute, you could end up with excess credits in this situation. So then you'd have an incentive to engage in tax planning, incentives to shift income from high to low tax locations, and low tax locations would be attractive for both tangible and intangible assets. I won't have time to go through all of this, but we also looked at what effective tax rates would be under territorial taxation. And we showed that you can see how that change to the tax system would matter for multinationals depended on their credit position. So that's the point of this. Second, we looked at the minimum tax, and I think we were the first paper to look at minimum taxes, and we actually picked a minimum tax rate of 15%, which is pretty interesting. And unlike with GILTI, we didn't really actually make a recommendation, but we looked at a per country minimum tax and an overall minimum tax. And the point of showing you this slide is just to point out that, let's say you had an overall minimum tax, what your effective tax rate on, and these are hypothetical tax rates, your effective tax rate on taking provisions of what this minimum tax regime into account that we modeled, if you were investing in a low tax country, like a rate of 5%, your effective tax rate depends on, of course, whether or not you're above or below a global effective tax rate of 15%. And as you can see from what I've circled, the effective tax rate matters a lot. So that's the theme of the first part of my talk. And just moving on to the next, so that was the theme of asymmetries. And the next is the three parties and the race to the bottom. So the traditional focus on host countries, which is what literature had done in the past, using statutory tax rates and tax incentives to compete for mobile capital, had neglected the role of corporate tax planning by multinationals. It had neglected the role of home governments that facilitate this tax planning through their tax codes. And what Harry and I pointed out was that there were three parties in the race to the bottom. There were host governments, there were home governments, and there were multinationals. For example, high tax host governments could permit income to be shifted out to tax havens as a way of attracting mobile capital. And home countries could cooperate in the shift if they thought the benefit to their companies was greater than any reduction in the domestic tax base. And so what we did in this paper, this paper is a Florida tax law journal paper, which I can send to people if they want. But what we did is we used various types of US data to identify the role of the three parties in the evolution of tax burdens on US companies between 1992 and 2002. This is an older paper. The period was of particular interest because the United States had introduced regulations in '97 that greatly simplified the use of aggressive tax planning techniques. And those regulations were known as check the box. And what they did was they introduced hybrid entities, which allowed US companies to avoid tax on intercompany payments like interest and royalties. And what we found is that the evidence indicated that from 92 to 97, the decline in effective tax rates on US companies was driven largely by traditional tax competition, by host governments trying to attract new capital, defending their market share. But after 97, tax avoidance behavior seemed much more important. Effective tax rates on US companies had a much weaker link with local statutory rates, and the disparity between profitability of subsidiaries in high tax and low tax jurisdictions grew substantially. So, we realized that the three parties working together were extremely important, and the tax havens were really playing a passive role. So I really believe that this research and the other research by accountants, lawyers, and economists was the impetus for BEPS, which focused squarely on the kind of base erosion and profit shifting that's made possible by the three parties working together in the race to the bottom. The idea, and that brings us to pillars 1 and 2, and the idea is to diminish the role of these home and host countries in the race to the bottom. But will tax competition end once we have pillars 1 and 2 in place? Is Secretary Yellen correct? Well, I'm not so sure. The theme of my talk is that details matter a lot. And now things are going to get very complicated, and I won't have time to explain them all. But there's a great new paper by Michael Devereaux, John Bella, and Hayden Wardle Burris that finds that the consequences for tax competition of the two-pillar solution depend on technical details. And warning, they're really tough to understand. And this is an Oxford University Center for Business Taxation policy brief. And they asked whether or not Pillar 2 would allow countries to engage in tax competition and which countries would collect tax revenues in general. And they focus on these model rules that were published on December 20th of this past year. And they looked in particular at incentives created by this qualified domestic minimum top-up taxes. And what that is a minimum tax incorporated into the domestic tax law of a jurisdiction. It's a minimum tax that can be incorporated into the domestic tax law of a jurisdiction, which would allow countries, this is super interesting, and I'm just trying to grasp it myself, but allows countries to impose a tax rate below 15% and collect the difference themselves up to 15%. So it effectively moves source countries to the head of the line to collect the top-up tax generated by Pillar 2. And it allows jurisdictions that adopt the Pillar 2 rules to still compete on corporate tax rates for entities that would be outside of Pillar 2's reach. So there still really could be tax competition on rates. They suggest that these top-up taxes can increase the incentives for jurisdictions to offer low and possibly zero corporate income tax rates to all the corporate entities operating in their country, including large multinationals. And so what's happening here is that jurisdictions could comply with OECD rules, adopt these taxes, and collect the top-up within the scope of Pillar 2. It's fascinating. And they suggest that they may even start to replace corporate income taxes, but they also mentioned that given the tax base would be financial accounting, this would be a significant change. And they write that the substitution of corporate tax with the top-up tax is significant and merits much more study. Okay, so now finally, in my final minute or 2 minutes, can I connect what I talked about in the beginning, tax asymmetries and international tax? And it turns out that I can. There's this great new working paper by Rishi Sharma, Joel Slemrod, and Michael Stimmermeyer called Tax Losses and Ex-Ante Offshore Transfers of Intellectual Property. And what they do is they focus on the role of asymmetric taxation of gains and losses in home and host countries in attracting foreign developed IP. So it really does bring this all together, and it is really directly related to international tax spillovers. It's a theoretical piece. The focus is on the incentive to transfer IP of uncertain value offshore, ex ante, before the success or failure of the IP is realized. And I just want to focus on 2 results. First, they show that asymmetric taxation matters. So they show that the multinational has an incentive to transfer its IP ex ante to a low tax jurisdiction whenever the treatment of losses is asymmetric in the home country. So intuitively, when the full value of tax losses associated with negative profits is not guaranteed by the home country, when you have asymmetric taxation at home, firms have an incentive to avoid potentially negative profits at home that they're not going to be offset. They're not going to be able to offset by transferring the IP to a low tax affiliate. The asymmetric taxation of losses when the IP is in a low tax affiliate is less important because it's a low tax country. And they also find that the incentive to transfer the IP to a jurisdiction with tax rates are comparable or even higher than at home exists if the foreign jurisdiction offers a more symmetric treatment of losses. So what we have now is a situation is in that firms can, countries can compete on their loss offset regimes, which is, I think, really fascinating. It's something to think about. So in addition to competing in tax rates, they can compete in these offset regimes to attract mobile assets with high income potential, such as intangibles. So again, this has been a little bit rambling, I understand, but the conclusion really is that the details will matter. This is super important for Pillars 1 and Pillars 2, which more information and examples are being published by the OECD. I guess, that has happened recently. I don't want to say every day because it hasn't happened every day, but it's going to be complicated. And we may not see the end to tax competition. There still may be a role for the three parties. So thank you very much. I can try to answer questions.
Thanks so much, Rosanne. I really appreciate the shout out to Details Matter and the recent research and bringing it up to current events. So we have a couple questions in the chat. The first one is, if Pillar 2 allocates a slice of multinational corporations' profits to market countries for the first time, regardless of those market countries' tax policy, could that actually induce a race to the top as opposed to the race to the bottom?
I think that incentive could actually be there, and it's certainly something to think about. I'm not sure how much that would matter, but I do think that that's possible. So it's a nice point.
I should have encouraged everyone still, if you want to submit any questions, please use the Q&A box. Another question that came up is, how closely is the US GILTI regime compliant with Pillar 2? And will Pillar 2 help multinationals by reducing competition from others whose countries have lower taxes on foreign source income?
Well, from what I understand, and again, on all of this, I could be wrong. And maybe Lillian, somebody in the second panel, can talk about this more. But I think that the OECD, the agreement, is trying to make GILTI work within GLOBE. So I think there's an effort to make GILTI what's called, well, let's call it Pillar 2 compliant. So it's somewhat close now, but it's not there. And then there's this issue of these new qualified domestic top-up taxes, which I think are just going to complicate the analysis quite a bit. And I wish I could say more on that, because I think we're all just starting to digest it now. We need to have seminars.
Thank goodness for these interdisciplinary seminars where we can pick these things apart. One question that came up too is if these QDMTTSs don't just completely preempt domestic corporate tax reform, which would have been a benefit of pre-December Pillar 2 reform. That
is an awesome question, and I'm sorry, all of my answers seem to be like I don't know, but that it's really interesting, because what these qualified domestic minimum top-up taxes that I'm really just digging into seem to do it. It's kind of clever, because what you're saying is, my first slide was that this applies to large multinationals. There's different definitions. There's different precise definitions about what large multinationals mean are. But a corporate tax rate applies to all of your multinationals, unless you change it so that it depends on your profits or how big you are, or something like that. So it definitely the Devereaux paper seems to suggest to me that there could still be this race to the bottom on your corporate tax, and on your corporate tax, which would affect those that your domestic firms and those that don't don't fall into Pillar 2. But then, as far as worldwide tax competition, you're always going to get up to that 15% rate. And there's always the question then of the possibility of where you should set up your firm in a world like this, where the corporate tax could, where the corporate tax could differ greatly across different countries. So we have a lot more work to do understanding this, and I think the OECD has has work to do too, with clarifications.
Great time to be in this area. Thank you so much, Rosanne, for joining us. It's been a real pleasure. You've given us lots to think about. It's my pleasure to introduce Stephanie Soon Johnston, who is Chief Correspondent of Tax Notes Today International and is going to be moderating the next panel. Thanks for joining us, Stephanie.
Thanks so much, Tracy, for that kind of introduction. And just to follow up on what Rosanne was talking about, I am also very interested in all of these questions. So in my job as a reporter, so details to come. It's a pleasure to moderate with what promises to be a fascinating and timely discussion about the spillover effects of corporate tax policy reform on intellectual property, or IP. Thanks to the organizers for inviting me to moderate. In my nearly 11 years of covering international tax, one topic that has come up over and over again is the taxation of IP, which is an important catalyst in an increasingly digitalized and globalized economy. What is intellectual property? It is a broad term to refer to intangible or non-physical assets stemming from human ingenuity. These can include things like trademarks, patents, copyrights, lines of code, drug patents, and the like. So because IP is intangible and is a key driver for profit in a corporation, it can be easily moved to other countries, often to low or no tax jurisdictions, as Rosanne mentioned in her great keynote. Governments in turn can set up tax incentives like patent boxes to attract IP, and just to define patent boxes, they're preferential regimes that taxes IP income at a rate below a country's statutory corporate income tax rate in a bid to stimulate local R&D development, research and development. In recent years, governments have been concerned that these companies have engaged in aggressive tax avoidance driven by these IP location decisions. And some governments have tried to introduce reforms to encourage their companies to bring back IP to their jurisdictions. And these reforms include the OECD BEPS project, which set out 15 different types of actions to tackle corporate tax avoidance, the US Tax Cuts and Jobs Act, which, as you all know, introduced the GILTI regime, a minimum tax on foreign income, and the FDII regime, the foreign-derived intangible income regime, which lowered the tax rate on exports of linked to IP located in the US. And of course, the BEPS 2.0 project, which Rosanne mentioned earlier in her keynote, which built off of the BEPS project. And so to discuss these reforms and their effect on IP location, I've got a great panel for you. If I could have my panelists up here on the screen. First I have Sebastian Bradley. He's Associate Professor of Economics at Drexel University. Lisa DeSimone, Associate Professor of Accounting at McCombs School of Business at the University of Texas at Austin. Lillian Faulhaber, Professor of Law and Associate Dean for Research and Economic Programs at Georgetown University Law Center. And Georgia Maffini, Tax Policy Director at PricewaterhouseCoopers in London. Welcome, everyone. Thanks for joining us. So just to start off, we'll have a discussion about IP and the short Q&A to follow. And if you have any burning questions for the experts, please send to the Q&A function in Zoom. And we'll try to get as many as possible. So let's begin. Let's see, Georgia, may I call on you? I wanted to find out what is the impact that IP shifting and IP boxes have had on government revenues. I understand you've studied this when you were in academia. If you could give us some framing topic.
Thank you, Stephanie. You actually handed me a very difficult question because we know that estimating the revenue effects of having a patent box is quite difficult because we don't know, because first of all, we don't have a counterfactual. But actually, I think we are not really sure what the right counterfactual is. So for example, we could think of three types of counterfactual. And the first one is that all the income that is, say, today taxed under a patent box could instead be taxed at a higher rate. For example, in the UK, we have a patent box at 10% and a main rate at 19%. So this is the counterfactual that actually the UK tax authorities have used to estimate the effect of the patent box. And they have estimated that for the 2018 year, these are the latest data, the loss to the revenue is of about 1.1 billion pounds, which is more or less 2% of total corporate tax revenues for that year for the UK. So not gigantic, but we have to believe in those estimates. We have to accept the counterfactual, but there could be a second counterfactual. So many countries, as you said, Stephanie, introduce patent boxes to attract more tax base, more patents, and the income related to that patent. So If this is true, then the tax base is larger, is a bit larger when you have a patent box. It's true there is tax at a lower rate, the extra tax base. But in this case, so the estimate of HMRC would be a bit of an overestimation of the real effect of the patent box. And then just to complicate things a little bit more, we could have a third counterfactual, and to understand that we have to go back to a paper that Michael Keane wrote in 2001, where Michael Keane tells us that in an environment without coordination among countries, it makes sense for a government to have a lower rate on the activities that are more mobile. So you can sustain your other rate, which is higher, on activities that are less mobile. So in this case, for example, for the UK, the patent box allows us a rate of 19%. Without the patent box, we would have a rate that is below 19%. The main rate would be below the 19% if we only can afford one rate. So again, also in this case, the estimate of HMRC would be a bit too large or too large in terms of losses that we incur under the patent box. So I'm not sure I've answered your question, but I think we have a number that is public for HMRC. It's about 2% of total corporate tax revenues. But if we look at the theory, that might be a bit too high, probably, as an estimate.
In our prep calls, sometimes the lack of an answer is an answer. So thank you so much for that. Just turning now to the US, now we talked about the foreign derived intangible income, or FDII or FODI regime, however you want to pronounce it. I wanted to ask Lisa, how does the FDII regime compare with other countries' IP boxes?
Yeah, sure. So I use FDII for what it's worth. I know there's variation on that. So first, to give a little more specifics about what the FDII is. So as you said, it's a deduction for foreign income that's deemed to be derived from intangible assets here in the US. To get at that deemed amount, you basically come up with what's considered an excess return. So profits above and beyond a 10% return on qualified domestic tangible assets. And that's supposed to be tied specifically to foreign markets. So these excess profits earned in foreign markets from what's supposed to be your domestic intangibles, you get that excess return amount and you get a deduction of 37.5% of that excess return. So there are a few dimensions that you can use to compare the FDII to IP boxes that have been implemented elsewhere around the world. To me, just based on that definition, the first thing that jumps out to me is its focus on foreign markets, income earned in foreign markets. And so that's a little unique in that it's not any intangible income regardless of its source, which is the way that a lot of IP boxes do work, or at least some of them. Second dimension to look at would be the magnitude. So that 37.5% deduction, what does that mean? It means you end up paying 62.5% on our current corporate tax rate of 21%. So an effective rate of 13.125%. It's not the highest and it's not the lowest. So there are countries that have IP box rates that are higher. In particular, France, Italy, and Spain, at least in some years, have had rates higher than that 13.125. But you also have a whole bunch of countries that have lower rates. The UK, Switzerland, Ireland, and Luxembourg all have IP box rates that are 10% or less. So we're somewhere in the middle there. And then finally, another aspect that you could compare the FDII to these IP boxes on is other requirements. So there's been a movement towards real activity being required in order to get that benefit, lower tax rate on your qualified intangible income. So the so-called Nexus requirements, or modified Nexus. And we really don't have that requirement as of yet with the FDII here in the US. So there's no prorated amount or condition on having actual domestic R&D like there is under the Nexus requirements of IP boxes. And that's been increasingly the case as a result in part of BEPS recommendations. So I would say those are the three big differences that stick out to me.
Mm-hmm. Thanks for that overview. And that brings the question, what has been the impact of FDII? I also use FDII for what it's worth, on IP location by US multinationals and on US corporate tax revenues. Sebastian, do you have an idea of that?
Sure. So this might be somewhat unsatisfying, much like George's response with the revenue effects of IP boxes in general. I think, and moreover, even more complicated in the context of trying to understand specifically the ramifications of FDII, given the set of other tax provisions that were all wrapped into the Tax Jobs Act. So I don't know, certainly too soon, but I'm not even necessarily terribly optimistic that it'll be, frankly, easy to come up with revenue estimates of FDII alone. And in the background, the Joint Committee of Taxation had scored the 10-year cost of $54 billion. So just to put that in context, that was about 5% of the cost reduction from the tax cut. So we have that estimate. I think it'll be difficult to come up with an estimate based on empirical data, but certainly as a theoretical, practical matter, certainly reasonable to expect that FDII would have, at the margins in conjunction with the rate reduction, would have marginally increased the incentives for locating IP in the US. I think there are a number of commentators who've also pointed out that there might be some incentives as well to tangible capital outside the US, which might. As an empirical matter, there's very little evidence, but a very recent working paper suggests that the TCJA overall resulted in a reduction in profits being shifted about 3 to 5 percentage points. But this is almost entirely attributable to a very small number of large multinationals, Alphabet, Microsoft, Nike, and some others, in whose financial statements you actually see references to being the result of repatriation of IP as induced by the TCJA. So that seems to be the best evidence we have. It's marginally better than anecdotal evidence, but nevertheless suggests that there has been some effect, maybe like many international highly concentrated.
Thanks, Sebastian. I think your audio is cutting out a little bit. It's a little. I think your audio is coming out a little bit. So just to recap, you were basically saying there's no real estimate out there, but the TCJ as a whole has yielded some effect, but we just don't know how much that's attributed to FDII in particular.
That's right.
Yeah.
So it's difficult to disentangle these different provisions. And many of these effects are complementary. But it seems that there's some effect. Right.
Gotcha. Thanks so much. Okay, so and then that brings me to the next question about BEPS, the BEPS project. I mean, that this BEPS project was finalized in 2015. Countries are still, I believe, implementing a lot of these measures. How did BEPS 1.0 address IP boxes and IP shifting more broadly? Did it have an impact, Lily? Since you were very intimate with these details.
Sure, thank you. So this is, I'm going to focus on Action 5 of the BEPS project, BEPS 1.0, which is what created the Nexus approach. So this is one of the minimum standards. It was a requirement. It is a requirement for all of the countries that were involved in BEPS and also the countries that are now involved in BEPS 2.0. And the general idea of the Nexus approach is that the amount of income from the IP that can benefit from the low rate of the patent box depends on how much of the R&D that contributed to that IP is done domestically. So this is a proportionate approach. Out of all of the R&D, how much of it was done in the country that provides the benefit? It's a little more complicated. If you want to talk about it more, we can talk about how outsourcing to unrelated parties can count as domestic, even if it's not actually domestic. But the general idea is that if you do all of your R&D in the country that provides the low rate, then you can benefit from the low rate. If you do none of it, then you can't benefit from the low rate. If you do some in-between amount, then you have a ratio that tells you how much income can benefit. And so I think this actually raises a really fundamental question that underlies Pillar 2 and the Treasury Secretary Yellen's statements that were done with the race to the bottom, which is what kind of race to the bottom, what kind of tax competition are we still allowing? Because what this is essentially saying is it's saying a jurisdiction can continue to provide a low rate to IP as long as instead of just attracting the IP, they now start attracting the jobs and the infrastructure that contributes to that IP. And I actually think that's really important, right? Because if you listen to politicians who are talking about what they're trying to prevent countries from attracting other countries' jobs and infrastructure. But if you look at what we in the tax policy space kind of view now as acceptable tax competition, we're creating incentives to use your rates to attract here R&D, but bigger picture with Pillar 2, things like jobs and infrastructure. And so to talk about kind of how this has changed how Action 5 has kind of changed the landscape, the FHTP every few years issues a progress report on how countries have reformed their laws in reaction to Action 5 and in reaction to other parts of the BEPS project. And so in 2021, they announced that out of 16 IP regimes, 13 of them had been amended to include this Nexus approach. 2 of them had been abolished. 1 of them has an asterisk. You can look at that and look at the footnote in the progress report. And one thing that I think is relevant to what Lisa was just mentioning is that FDII is not listed as an IP regime. FDII is listed as a separate regime that the US has pledged to abolish. So this is interesting possibly for US audience members who might be surprised to know that the US is planning on abolishing this. I know that that's been in proposals, but the US has not actually moved forward with it. But it actually highlights that if the US doesn't get rid of FDII, it is something that the FHTP, the Forum on Harmful Tax Practices, that's the part of the OECD that implements Action 5 and other anti-tax competition measures, that this part of the OECD is actually focusing on, and that the OECD is very aware in many ways runs afoul of the Nexus approach and other rules, as Lisa suggested.
Thanks so much for that overview. Yeah, that is an interesting aspect of the FHTP, and that brings me to my next question about BEPS 2.0 then. How, if it's implemented, how will this agreement affect IP boxes and IP shifting? How are taxpayers responding in anticipation of these 2 pillars? And that's sort of an open question. I think maybe Georgia might be well placed to respond, since she's in the middle of advising clients on this topic.
Yes, Stephanie. So I'll start with the theory, and then very quickly you will say, like Rosanne said, the details matter a lot when you start looking at the implementation of Pillar 2. But in terms of the broader perspective, a more theoretical approach perspective, clearly, if we are looking at patent boxes that bring the rate down below 15% or just below or just above, depending if you account for the effect of the substance-based carve-out. But if we look at that type of patent boxes, you may think that they will not be beneficial after Pillar 2. Okay. In reality, what you can think is that you can mix high taxed income with income that is taxed under the patent box. And as far as your average comes up around 15%, you should be okay. And in fact, I think that this type of facts is what is of interest to many governments. Many governments that will keep the patent boxes to remain competitive as far as the average brings us above 15%. So I don't think, if we look at this, I don't think that patent boxes are dead with Pillar 2. Of course, their benefit will change, but they still have a role for the jurisdictions that want to remain competitive. And frankly, some countries understand this very well. And this is a little bit what the paper by Mike Tevro and John Vella really tells us when Pillar 2 will come in. So this is more at the theoretical level. In fact, again, details matter so much in terms of the application of Pillar 2. because of how some patent boxes are structured, we have seen cases that whereby if a company is running a commercial loss, an economic loss, and a loss for accounting purposes overall in a jurisdiction, and at the same time that company claims even a small amount of patent box on some profit, of a stream of profit, overall that company will have to pay a top-up under Pillar 2, even if the company runs an overall loss. Now, when I explain this, I know that people are get a bit confused, but this is how the rules seem to be working, at least for the moment. You can imagine, Stephanie, that having to pay a top-up tax, essentially corporate income tax, when you are running a loss is a huge problem for a corporation. And this becomes even more of a problem if the losses are sustained across a long period. And this is normal for companies that use patent box because they have periods of investment that can last a few years, and then the patent comes up and it's profitable or not as well. These are companies that have some investments and some profitable patents, and sometimes the average is just a loss. So I think that I don't think we have thought about these issues hard enough. The rules are very new; they're not stabilized yet. But for a company that needs to go into the patent box, we should also look at the patent box in terms of the interactions with the Pillar 2 rules and these losses, because that could be really problematic, I think. The other point is that so many, when we look at Pillar 2, we ask whether now companies will shift patents from jurisdiction where we tax at 15% to higher tax jurisdictions, because maybe it now makes sense, given we have a floor at 15%, maybe now it makes sense to move the patents to higher tax jurisdictions. We have seen many companies that are thinking about that, to be honest, but the rules for the asset transfers within the same group are still unclear. And so I think that for the moment, we will have to pause and understand really what these rules means, and in particular, how deferred taxes will be calculated around that, whether you have to pay a 15% top up when you move the assets. This is something that you don't do today when you move the asset within the group. In some countries, you don't pay that tax. So we have to see, really. I think that in practice, when you apply the Pillar 2 rules, we don't still have all the pieces of the puzzle to understand where IPs will be moving. But we have seen cases where we think that they remain where they are at the moment because Pillar 2 applies a little bit of a tax in this transaction, but to be seen, really.
Yeah, it seems like just to be clear that these model rules that the OECD has put out are final, and the countries are expected to adopt them, yet all these questions keep popping up, and I'm sure we'll be seeing a lot of guidance coming out of the OECD as needed. Does anyone else have any thoughts on how this steps 2 is going to affect IP? What industries will be affected most by these rules, by FDII, by IP shifting? Which, in your view, is most affected? Anybody want to tackle that one?
Sure, I can take a crack at that one. I think it's the usual suspects that we see splashed across headlines, right? I mean, it's going to be the big tech firms, particularly with respect to Pillar 1, the allocation of a certain amount of profits by large corporations to a market jurisdiction. A lot of that was kind of the thought process behind that was motivated by this idea that you could have a bunch of users of a platform like Facebook in a jurisdiction, but the company doesn't have any real activities there. It doesn't have the activities, the risks, the things, the assets that we typically tax a company based on the location of. So I think tech companies are going to be pretty impacted. And again, bear in mind too that both pillars have a size requirement. So we're talking about really the largest multinationals out there. or at least in the case of Pillar 1, it's just the largest, and in Pillar 2, we'll find out currently it's not necessarily the largest, but there is a size threshold for it to kick in. And then the other industry I would throw out there as well that typically is the other usual suspect is pharmaceutical companies, because they tend to have some of those excess profits that would get caught up in some of these provisions.
So much. We're starting to get some questions from the audience, so I'll go ahead and ask a couple of them up for grabs for everybody. How has the elimination of the double Irish arrangements impacted the location of IP? You want to tackle that?
So just anecdotally, let me know if my audio cuts out again. Apologies. Anecdotally, in any case, I referenced these financial statement notices regarding the impacts of TCJA overall, or perhaps explaining the profits shifted out of the US following the TCJA. In the case of Alphabet, shift or repatriation of IP in question would presumably also strategy. And so it is, in fact, perhaps unclear whether that was really a response to the TCJA or whether that would happen. But that's just an
and here's a question for Rosanne, from Rosanne. What are the costs and benefits of adopting a patent box? You know, we're talking about how maybe little they do raise in revenue. It seems like there must be pros and cons. What are the costs and benefits? And if the U.S. does abolish the FDII, would the U.S. adopt a patent box?
So I can start and others can chime in. I think one major thing is that there are internal political benefits, right? So, and this is what you see in other countries, is that we can sit here and talk about the actual, empirical studies suggesting that they don't actually raise revenue, they lead to losses of revenue. That kind of doesn't matter, right? At the end of the day, politically, if there is a demand to be shown that the US is trying to attract certain types of companies, then a patent box is a good tool in that. And I think you can see that, starting before the BEPS project, there were discussions of the US having a patent box. There were proposals for it within the US. And I assume that if FDII were eliminated, there could be similar demands for it. Whether or not it would actually pass, that's when maybe the empirical support actually matters. But in terms of sort of playing to multinationals who are threatening to move their IP, that's when a patent box has the best benefit. In terms of the costs, I think it really, and this comes back to Rosanne's own words about the technical details matter, right? I mean, I think that the design of the patent box really determines how much it affects loss of IP and whether or not it actually draws in R&D, as well as just having IP being shifted here, or vice versa, preventing IP being shifted while still keeping R&D here, or allowing R&D itself to move outside of the country. Arguably, that's what the Nexus approach was meant to do, right? It was meant to affect so that the IP and the R&D went together. Again, details matter. The Nexus approach has some little loopholes in there that let some of the R&D be done elsewhere while still counting as being domestic R&D.
Anyone else have any thoughts about the question? And feel free to, anyone chime in whenever you can respond to, we'll try to make a conversation, keep it flowing. So going back to my questions, as far as many OECD and tax experts have been worried about the ability of M&Es to shift these profits, right? Where they have no real economic activity. If these profits shouldn't be reported in low tax jurisdictions, where should they be reported? Should it be in the country of corporate residence and, in the country where physical capital or employment is located, or where sales take place? I mean, where should this happen? Any strong opinions?
So, I mean, this is the age-old question, right? historically, it's been based on functions, risks, and assets, where those things are located. That's the way the transfer pricing rules typically work now, both in the US and internationally, with an increasing focus on the function piece, or the boots on the ground, the actual people, as opposed to assets, which are relatively easy to many of them to pick up and move, just signing contracts on paper. We're talking about intangible assets, right? And then risks are also fairly easy to sign contracts so that your subsidiary in a low tax jurisdiction bears more risk, and so you can allocate more profits there. So that's typically where profits were supposed to be allocated. And as I said already, you know, there's this motivation for wanting to allocate a portion of profits to the market jurisdiction because of the idea that the user base is in effect almost, you could consider it an asset of the firm. If you have a bunch of users in France that allow you to sell a bunch of ads in France, even though the people who are selling those ads are located in a low tax jurisdiction, like say Ireland, they're only able to sell those ads because of your user base in France. So that's kind of motivation for this market allocation, but there's a problem with that, which I don't know that it's fully solved with an IP box, but the problem is that there are two ways that you can incentivize innovation, right? You could offer incentives up front with the ongoing R&D, things like super deductions and credits, or you can offer a lower tax rate on the income that's generated off of that IP. And as Lily said, you know, what we're trying to do with the Nexus requirements is to make sure that those two things are happening in the same place, but they aren't always. And so you have countries giving deductions and credits at a relatively high normal tax rate. If that income then gets allocated, whether by the multinational to a low tax country or by some rules to a market jurisdiction, you're removing some of that income from the location where that R&D has been done, where basically that home country is effectively almost subsidizing that innovation that another country gets to reap the benefit of. So it's not tremendously straightforward to me that I see the arguments for allocating to a market jurisdiction, but I think there are complications with that. And there are complications too with, you know, if you are able to offer a low enough tax rate with your IP box to keep the income in the same location where you're encouraging those R&D through the R&D incentives, offering that lower rate also creates a mismatch. So the country isn't getting back all of its return on its initial investment in innovation, to put it simply.
Much. And what is, so you mentioned the Nexus requirements and patent boxes. What have been the legal and practical effects of the OECD's modified Nexus approach under Action 5? Maybe I can call on Lily to comment on that.
So I can speak mostly to the sort of legal changes, which is just the countries themselves actually changing their laws, right? So what has to happen is that they actually have to change their patent boxes, submit them to the Forum on Harmful Tax Practices and have them reviewed. And so this is where those numbers out of the 16 came from, right? Is the 13 who have changed theirs to actually require the location that the R&D be done domestically in order for the income to benefit. 2 of them have just eliminated their patent boxes because they didn't see the benefit of doing that. I think the bigger question is the actual economic ramifications, and I'll turn that over to somebody else to sort of see if we've been able to actually study this. It's hard to unpack because, as Sebastian suggested, a lot of reforms have happened at the same time, right? And so figuring out whether or not including the Nexus approach requirements in your patent box has actually led to more R&D happening in your jurisdiction. At the same time, the US had major international corporate tax reform. At the same time, there were a lot of other changes that were happening. So it's been kind of hard to unpack, but if others know of good research on this, that would be great.
So I might jump in. Well, I'm sure. I don't know that we know anything about the impact of the modified Nexus rules yet. I think I'd say it's fair to say that we know a fair bit about what prior Nexus provisions, what effects those had, to the extent that countries had any in place. A lot of the sort of more substantial effects that we see of IP boxes terms of things like patenting activity, many of those effects are really concentrated in the few countries that had requirements in place. So one would imagine the same would be true, and some of my work would also see that has fairly pronounced effects on things like mergers and acquisitions, for example. So it does seem that they matter, at least historically they mattered in the prior version. It's a little harder to know how they might matter by Nexus rules. So maybe other panelists have thoughts on how that sort of changes the game. It does seem like some notion of requiring domestic R&D to take place does not surprise me.
I think, Stephanie, just to add some really anecdotal evidence, not on the R&D activity within the country, but it seems that the Nexus has stopped, at least within Europe, patents moving from one country to the other, moving from the country where research had already happened before the Nexus rule was in place to other countries. So, and this, I think it's an effect. I haven't seen any academic paper, but it's sort of well known. So really, and that talks a lot to the fact that patent boxes are more there to stop patents leaving than incentivizing R&D activity.
Much. So I might mention that my publication, Tax Notes, has reported that many U.S. tech companies have repatriated IP, but pharma companies have tended to keep their IP offshore. What do you think is driving that? Then.
So I will say one thing that that sometimes gets lost when we talk about tax incentives for IP is that when you're dealing with IP, and especially when you're dealing with industries that are very IP heavy, there are factors other than tax, shockingly to all of us, right, that are going to actually play a role. And so I think, when Lisa was saying that you can either have like a before the fact or an after the fact incentive for IP, you can also have a whole third category of other ways of creating incentives, right? You can have different patent rules, you can have, longer patent protection, all kinds of things like that. I think for pharma companies, one of the issues is that sometimes there's actually, in terms of sort of trials and regulatory issues, they have constraints that, that may make it harder to repatriate. Now, those of us on the call who actually work with pharma companies might have more things to say, but there are certain sort of, even if they're not legal constraints, there might be sort of cultural expectations that the IP be booked in certain locations. And I just think it's sort of worth reminding all of us that taxes are an incentive and multinationals respond to them. But at the end of the day, multinationals also respond to other things that are outside of our space that sometimes actually really have serious effects on where IP is, what IP looks like, where R&D is done, no matter how hard we try to change that with tax rules.
Yeah, it's not all about tax. Oh my gosh.
It's very disappointing whenever I think about this.
That's a really great point, and I'll tack on that. Taking Ireland as an example, they have a lot of programs funded by the government there to help train their workforce. And so if you're going to put, you want to put your IP where you have boots on the ground who are actually doing the work, having knowledgeable employees is going to be a key component to that. And so there are these other things that governments can do to attract companies, particularly in the pharmaceutical industry, to come do a lot of their work in that country.
Much. We have, so just to switch gears a little bit, we actually have a question from Twitter, which I got ahead of time. Could you please comment on the reduced local spillover effects of the R&D credit in a more globalized economy? Should R&D credits be reduced, more targeted, and be unavailable with cost sharing? Any thoughts on that for Good Tax Takes, which is the account that asked the question?
Maybe, Stephanie, I'll just respond to the first part of the question. And it's true in theory that, the more globalized you are, the more your R&D will spill over to other countries, even if you have yourself financed entirely through maybe good schools or good infrastructure or grants, that R&D tax credit. That's true. That's probably a little bit of a cost, but we should remember that I think there is a lot of evidence that says that the technological frontier, so good and increases in productivities, happen only through innovation, and we have to finance that innovation. So, and higher productivity means higher standards of living for the population. So even if maybe in a globalized economy there is a bit of a loss on the edges, we still have to remember that financing innovation and the type of innovation that moves the technological frontier remains key for growth and for standards of living. So we shouldn't be too afraid to do the right type of, incentivizing the right type of innovation.
Thank you. Another question coming in from the chat. How do the pillars affect the incentive to use cost sharing agreements? Anyone have any thoughts on that question? Is it too difficult at this point because details are lacking?
I can give it a shot.
Okay.
So first, let's explain what a cost sharing agreement is. Basically, it's a way for within a multinational, typically in this context, to share the development of intellectual property. So you have some of the development going on, let's say in the parent country of the US, and you have some of the development going on. I like to pick on Ireland just because it's what I talk about a lot in class. I have a lot of cases from Ireland, so let's pick Ireland. You have a subsidiary in Ireland who also engaging in R&D, and they're jointly working together. At least that's the idea. Used to be the case you could just have Ireland finance some of the R&D, and in return they got a share of the ownership rights of the profits. Now more and more with increased enforcement, increased focus on where activities are actually being done, the Irish subsidiary would typically also have to be actually engaging in R&D. And so they're sharing in the cost of development. And the benefit of doing that is that they each get a respective share of the output of the intellectual property. And so this is, to really simplify things, it's kind of a nice way for a multinational to be able to move the ownership of an intellectual property, or at least a portion of the ownership, to a low tax jurisdiction. And so with the two pillars of BEPS 2.0 coming in basically enforcing a minimum tax rate, and then also potentially allocating a portion of that excess return to a market jurisdiction, you are basically going to remove some of the incentives, I think, to locate your intellectual property to a low tax jurisdiction, the sorts of things that Georgia was talking about with potentially locating your IP in higher tax jurisdictions, or not thinking so much about putting it in that low tax jurisdiction via the cost sharing agreement or the other IP migration strategies that a company can use.
Thanks so much for that. I guess we're kind of drawing near to our end, but I just wanted to throw out one question to all of you. What do you think the future of IP box regimes is, or will we see more countries adopting them or not? Anybody want to take that?
Probably we should all respond, but I'll take a first stab at it and come back to question that I think Rosanne posed about just general costs and benefits of boxes. I think it's very difficult to know, and part of that is noted, right, is that details matter quite a bit, and of course we tend to think of IP boxes as sort of monolithic entities, but they're in fact all quite different given the set of provisions they combine. So they can have very different effects. I think it's an open question, though, at least to me and probably researchers, as to whether patent boxes are primarily rewarding pre-existing IP or actually inducing new innovation. I don't think we know the answer to that yet. There's some evidence maybe that sort of increasing patenting effort would suggest that there's some new innovation taking place, but most of what we see so far could be consistent with firms simply patenting things that they already held as trade secrets, for example. I don't think we can rule that out. So there's a potential windfall for pre-existing IP. And then there's the question about, how much IP is actually sensitive to being relocated. We think of all IP as being mobile. trying to retain or attract mobile IP with something like an IP box, of course, requires a lower rate on that IP, which might still raise revenue. But there's also a further possibility that the set of IP that you weren't likely to lose is now paying a lower tax rate. And so it's not even clear net what the revenue gains are. I think, notionally, we would hope that they do, in fact, provide some modest incremental incentive for innovation in the long run. And if that's the case, then I think ostensibly we're banking on those productivity gains and increase in economic output to drive increased revenues. But I don't know that we know. I don't know that we have the evidence to conclude that that's likely to actually happen. I think it's likely that we'll see more IP boxes, certainly absent any kind of global agreement on minimum tax.
Anybody else have any thoughts? Tricia?
Maybe, Stephanie, I'll repeat a little bit what I said before, in the sense that I think, as actually Rosanne has already pointed out, we can't think that tax competition among countries is finished with Pillar 2. Is very important. It will remain very important for countries to attract economic activity. And patent boxes that can be mixed with other income can still be an effective tool to attract business or profits or activities. And for some countries like the UK, the patent box has been part of a broader strategy to attract headquarters of multinational groups. And the thought is that headquarters attract highly paid jobs and have some positive spillovers for the economy. So I think that there is still probably a place for patent boxes in the international tax system. Actually, Australia has just, I think, legislated, or anyway, there is a proposal for a patent box in Australia when we already knew that Pillar 2 was coming. So maybe still some role, although really some of the detailed rules of Pillar 2 make the working of patent boxes very difficult to understand and very difficult to assess in the longer term.
And it's just worth pointing out that Australian patent box, which is going live sometime this year, that the rate is 15%, which I don't think is coincidental.
And I'll just follow up too that I actually think long term, one of the big questions is sort of what's the many years into the future effect of Pillar 2, right? Is Pillar 2, first of all, who's actually going to adopt it, right? Because nobody has to adopt it. And who, if everybody adopts it, is it actually going to have the effect of moving everybody's rate to 15%, including the countries that have rates above it, which then makes any patent box under 15% less appealing, because you can't necessarily do the sort of mixing that Georgia was suggesting unless everybody also adopts a Pillar 2 version, which has the substance-based income exclusion, in which case then you have one 15% rate for everyone, and then everybody is competing on their patent boxes, and they're competing on patent boxes that are essentially similar to the Nexus approach, because that's kind of what the substance-based income exclusion is echoing. So that I just raised sort of all the questions of Pillar 2 and patent boxes, right? Is that there's a lot of uncertainty about what the effects all of these are going to have, and if Pillar 2 doesn't lower everybody's rates down to 15% long term, then patent boxes might be more appealing because they allow countries to have lower rates while still staying above while still keeping the rates that they wanted to keep for their corporate income tax. So I think I echo everyone in saying a lot of this depends, right, on what patent boxes look like and what Pillar 2 looks like, but I don't think it's obvious until we actually start to see some of the consequences.
The thing is, the Pillar 2 rules probably won't take effect till 2024. I think those questions will have to stay unanswered for a little while. So I apologize. That was actually supposed to be my last question, but I did get more questions coming through the chat. I'm so sorry. So the one question here, what does the location of IP make any difference with regard to productivity? That seems like a big question. Again, is it do we not know because the data isn't there? I think that is probably the answer.
But I think we don't know exactly, but it certainly, there's plenty of evidence of R&D complementarities, right? So from that perspective, you could at least guess that R&D that's located or performed in close proximity to other R&D and other physical investment is likely to be more productive than R&D. So I think location matters to some degree. And and this gets back a little bit back to the question about spillovers. Broadly, a tough question to answer. There are certainly local spillovers, and there are probably global spillovers from R&D. I don't think we know the balance of those other things, but we do know that overall that innovation is good, and perhaps if we look beyond national borders exclusively, then we should all be in favor of anything that promotes increased innovation, no matter where it happens.
Another
And
question.
maybe,
Oh, yep.
sorry, Stephanie, just maybe something on the promotion of innovation, Sebastian, that we forgot to say, but also we tend to think that innovation sometimes fails if left to private markets. So that's why we need government to step in sometime. Then, of course, whether you want to have R&D incentives or patent box is another matter. But I think there is evidence that innovation left to purely private markets is provided at a level that is below the optimal one.
One other question. When FDII was enacted, there was a question with regard to its WTO compatibility, as in whether it did not constitute an export tax break. Have there been any challenges to the regime thus far? Has anyone heard anything to that effect?
I actually think this comes back a little bit to the US's international posture about FDII, which is the US's international posture about FDII is that they're getting rid of it. The US's domestic posture about FDII is different, but I think that matters in terms of the willingness of countries to actually bring challenges before the WTO. But it's been around for a few years now, so we'll see if at some point. I mean, I know that the EU threatened challenges a few years ago, and if it sticks around at some point, those challenges might actually turn into a real WTO challenge.
And just about FDII and about harmful tax practices, Delia. Actually, I was going to ask what happens that what can the form of harmful tax practices do then if FDII isn't abolished and it comes back on the list of harmful tax practices? Like what happens then, just so the audience knows.
So the effect of if you're found to actually have a preferential tax regime, so this the sort of way that this works is first it has to be found preferential and then it has to be found harmful. So if you're found to have a preferential tax regime that is harmful, then you either have to abolish it or other countries can implement their own countermeasures to it. So essentially, if the US were to keep FDII on the book, it were found to be harmful, then that would actually allow other countries to tax any companies that benefited from FDII in a more, I don't want to say punitive exactly, but at a higher rate, right? So there could be some kind of measures that were implemented by other jurisdictions. Normally, we don't actually see this play out because countries actually do abolish their measures. But as we all know, and as we've seen with Pillar 1 and Pillar 2, the one of the criticisms of the US's involvement in the OECD is that the arm of the US government that actually agrees to things at the OECD is different from the arm of the US government that actually legislates things. And so if nobody in Congress is willing to get rid of FDII, then at a certain point, Treasury's assurances that FDII will be eliminated could be ignored, and the OECD, in the form on harmful tax practices, could find it preferential and harmful, and that could actually lead to other countries imposing tax measures on companies that are benefiting from it.
That's for that explanation. So I guess the big question then is how confident are we that the US is able to first adopt the guilty reforms, and abolish FDII, and all of these things. Like, how confident are we that the U.S. is able to do all this? Any thoughts on that very big question? Or just from what I understand?
I'll be surprisingly optimistic here, which is that, when I was involved in BEPS 1.0, there were lots of letters that were written by members of Congress that were saying that, the Treasury didn't have the authority to agree to anything, and that all of this was inconsistent with international law, and that this was, nothing that the US would ever agree to. And then basically we just implemented all these things that we didn't even have to implement, right? I mean, we incorporated Action 2 anti-hybrid rules. We ended up changing 163J, so it looks essentially exactly like Action 3. We ended up passing GILTI, which if you read the Action 4 report, GILTI is right in there. So we did all of these things in the United States, and by we, I mean Congress, right? So not we at all, but Congress did all of these things in the United States, even though I think if you had looked in 2015 and asked, is there a chance that in 2017 we're going to end up passing all of this? I think nobody would have thought that was the case. So I do actually think that international tax reform can sometimes surprise you. And I think that you can end up having surprising allies who maybe don't even they're not even explicitly allying themselves with these positions, but they end up incorporating some of these rules and implementing them. And so in some ways, this looks really unlikely right now. And I know that timetables have been pushed back. And I know that there are questions about whether or not we'll ever have a legislature in the United States that is going to agree to something like this. But, it's not crazy to me that in 2024 or 25, we suddenly look at this and we're surprised by what's been passed. I don't necessarily see a path for how that happens, but I will say I'm open to being surprised to seeing that happen.
I am personally very invested in the optimism, just because they'll make our copy, keep us busy, for a very long time. So I guess anybody else want to weigh in on prospects? Or we'll end on an optimistic note. All right. Well, I guess we have no more questions to the chat. So I suppose we can finish a few minutes early, if that's okay with the organizers. And thank you so much for all of your great thoughts. And I am looking forward to checking in with each of you when these developments solidify, and hopefully watch out for more great content from Tax Notes. That's my little shameless plug there for everybody. And Sebastian, Lily, Lisa, Georgia, thank you so much for your participation and for your great comments. And I hope to speak with you all soon.
Thank you. It's been a pleasure.
Likewise, a pleasure. Thank you.
Thank you.
Thank you.
Thank you.
Okay. Thank you so much. So if that is okay with the organizers, I'd like to hand over the baton to Donald Marin. He is an Institute Fellow and Director of Economic Policy Initiatives at the Urban Institute, and his panel will be on border carbon adjustments, another easy topic to discuss. So I'll give the floor to Donald. Thank you so much.
Hey, thanks, Stephanie. And hi, everybody. And I asked my fellow panelists to join me, turn on their cameras and whatnot. So we're here to talk about carbon border adjustments. As you all know, climate change is a big, giant issue that we face, both on the domestic front and as a world. Lots of policy discussion about what one does about climate change, slowing it domestically. You can imagine tax policies, pricing policies, regulatory policies. There's a whole giant toolkit. But our economy is connected with the rest of the world. Our environment is connected with the rest of the world. And so it's very important to think about spillovers, to think about how the policy choices we make at home might affect the rest of the world, and then to think about how we might use various policy levers to address the economic and environmental connections that can happen. And in particular, this idea of a carbon border adjustment. To talk about that today, we've got three super experts on this topic that I will quickly introduce. First up, we have Tatiana Falco, who's an expert on international tax and environmental taxation. Like everybody on this panel, she does lots of things. Among them include serving as coordinator for a coalition of finance ministers for climate action at the World Bank, in particular in their thinking about carbon pricing. Then we have Billy Pizer, who has a very distinguished career in academia, in government, and now in the think tank world, working on environmental economics issues. He currently serves as Vice President for Research and Policy Engagement at Resources for the Future. And third, we have Katrina Rourke, who's also been actively engaged in policy circles for quite a while on carbon and other issues. She currently serves as Senior Vice President for Policy and Research at the Climate Leadership Council and as Executive Director of their Center for Climate and Trade. And let me remind you as we go along that we welcome questions in the Q&A box, so please share your thoughts and questions as we go along. And let me start with Billy. Billy, if you could set us up for today's conversation. What is a carbon border adjustment? Why is it important? And what are some of the major issues that arise in trying to implement and design one?
Sure, thanks, Donald. And thanks to the Urban Institute and the UNC Center for organizing the event, all of you for joining us. It's really great to be here talking about these topics. So, a carbon border measure is basically a policy tool to address the trade consequences, the spillovers, as you were just saying, of domestic policies to reduce greenhouse gas emissions. So if you think about it for a second, the fundamental problem is that when domestic regulations try to reduce emissions, carbon dioxide, methane, other greenhouse gases, it tends to raise the price of those goods produced domestically. And this is not so much of a problem when you're regulating electricity or the transportation sector. These higher prices tend to reduce demand, and that's actually a good thing in terms of shifting towards less carbon intensive or greenhouse gas intensive products. But it's a problem when you're regulating internationally traded products. Think of steel or aluminum, cement, nitrogen fertilizer, where the higher costs from domestic regulation will not just reduce demand, it'll actually shift demand to imports from unregulated or underregulated jurisdictions. And this is a problem, it's both an environmental and economic problem. You aren't really reducing domestic emissions if you simply push those industries to produce elsewhere. We care about the global emissions of these gases, not the domestic emissions. It's also an economic and a political problem if we're shifting jobs and economic activity overseas. So the border measure is a way that we would basically tax or put a tariff on imports from these other jurisdictions to compensate for the domestic regulation that occurs in the United States, for example, or in another jurisdiction like the EU. So what are the major issues? So first off would be the form of the domestic regulation. It's relatively easy if you had a domestic carbon tax or greenhouse gas tax to then tax the greenhouse gas content of foreign goods. The EU, for example, has a cap and trade. That's a little bit harder. There's still a price in the market. That price fluctuates, so you'd have to figure out how to put a tariff based on a fluctuating price. It also is a little trickier because in the EU, at least right now, they have free allocation for these industries, and you'd have to think about, well, how does that affect the costs to these industries and try to make it comparable to the tariffs on imports. But it gets really tricky if you're in a world where your domestic regulation is not price-based. Maybe it's efficiency standards or emission standards, and it's not so obvious. You can't really put those regulations on the imported products, and you'd have to try to figure out some price equivalent, and that's really kind of tricky, if not dubious. So after that question about the form of the regulation, there are a whole bunch of other questions that we could talk about. So probably at the top of the list is what gets covered. So most people, when they talk about border measures, they have in mind the very carbon intensive primary products like steel and aluminum. But steel goes into cars, and the price of cars might go up, and you might think that's a disadvantage for the car industry. So there's a real question about like how far down the list you go in terms of what we think of as energy intensive or emission intensive trade exposed industries. A second question is how specific you get in the products. So domestic regulation, the way we typically think about it, is usually at the facility level based on emissions. Imports are focused on products because that's what we see coming into the country. So there's a question, if we're going to have a carbon content for steel products, do we have the same carbon content per ton of all steel products, or do different steel products get different carbon contents depending on what product they are, but also whether they're made by blast furnaces or electric arc furnaces. So there's this question of how we define the categories or subcategories of products to set the tariffs. Another related question is what emissions to cover. Traditionally we think of direct emissions, like how much was emitted by the factory that produced the steel. But aluminum is frequently made with electricity, or electric arc furnaces use electricity. So maybe we want to include electricity. If you start talking about cars, it's not necessarily the car manufacturers, it's the upstream steel manufacturers. So in kind of common parlance, this goes into scope 1, scope 2, and scope 3 emissions. But you have to decide what sorts of emissions you're going to cover. Another tricky issue is how you deal with foreign data. So we may be very good at figuring out the carbon content in US products or from US facilities, but how do we do that for foreign producers? I guess then we get into a few other little smaller issues. I'll just kind of quickly note, there's a question, what do you do with poorer countries? Do you want to have the same border measure for all countries, or do you have a special exemption for poorer countries? What do you do if other countries have comparable policies? Do you try to have a club and just have border measures on the countries that don't have adequate internal regulation? And then there's the question of what to do about exports. Do you try to somehow rebate the fees that are charged domestically on products that are destined for exports? Because obviously the exports go into another country and there's really nothing you can do in that jurisdiction. The last thing I'll just mention, mainly because it just happened recently, is Senator Whitehouse actually introduced a proposal last night that is specifically focused on the industrial sector and trying to develop a regulation and approach that works for domestic industries and imported goods in kind of a parallel fashion. Usually border measures are thought of as kind of an afterthought after you have the domestic regulation. And Senator Whitehouse is really targeting industrial sector emissions with imports, front and center next to domestic regulation. So with that, let me pause. I've thrown up a lot of stuff, and I know we're going to go through a bunch of questions, but we can come back to those later on if people want.
Yes, yeah, I think the takeaway so far is there are a lot of issues. Tatiana, it sounds as Bill is describing, right? The EU has been working on this, has perhaps gone the furthest in preparing a carbon border adjustment. Could you give us a high-level view of what they're up to and some of the issues it faces?
Sure, Donald. So the EU is actually the only region so far to have proposed a border carbon adjustment measure. There are other regions that have contended with the idea. Billy just mentioned the US, which is based on a regulatory measure. The EU's proposal is actually based on an emissions trading scheme, because they have that at EU level. And so the CBAM, which is the Carbon Border Adjustment Mechanism, is just an acronym for the measure that is introduced there, was designed in order to create a common and uniform framework to ensure equivalence between carbon pricing policy applied in the EU internal markets and the carbon pricing policy applied on imports. So it's actually not an extension of the EU ETS or the emissions trading scheme that they have running on regionally. It is a mirror approach, and that is actually quite important for legal purposes, which I will probably mention later on in this seminar. So the sectors covered there are iron and steel, cement, fertilizer, aluminum, and electricity generation. And it's important to note that the products are measured according to actual emissions released by the products processed abroad. which is again a super important point, especially if considering a World Trade Organization issues, because from a trade perspective, a border carbon adjustment mechanism is compatible with WTO rules if it mirrors or if it's compatible with the domestic carbon price employed. What we see here with the EU system is that the price might not actually reflect the domestic market, but it is actually a reflection of the actual emissions released abroad, which might bring about different issues from a trade perspective. Again, from a trade perspective, in the EU CBAM, they have no right, importers will have no right to trade those surplus allowances on an ETS secondary markets. This might be an issue, again, from a trade perspective, because it makes the system for importers different from the system that exists for EU operators. So if you think about, an aluminium producer in the EU, that person will be subjected to the ETS and will pay a price. And whatever allowances it has exceeding the price paid under the emissions trading scheme, it will be able to negotiate it on the secondary market and possibly make a profit out of it, whereas the importer will not have access to that secondary market. So if you compare the approach of the importer with the domestic producer, you actually have dissimilar situations between both of them, which is something that the WTO rule tries to avoid. The original proposal contains oversight of the EU CBAM by national climate authorities. So essentially, different member states would oversee the imports occurring to each member state. There is ongoing debate as to whether this will become centralized or not. There is a council proposal and there is an environmental committee proposal at parliament level that hasn't been decided yet. Is expected to be decided in July. It is an important procedural issue because it either elevates the issues to EU level or it maintains all of the administrative oversight at national level, at member state level. Like I said, it's actual emissions from third countries, but there are certain rules that allow for default value based on EU, based on the EU producers' averages. That is the case, for example, for electricity. It's the only market where an importer is allowed to use EU averages as a default rule. And then, of course, importers are entitled to claim a reduction of the corresponding tariff applied domestically for any carbon price paid in the country of origin. That is, as long as the carbon price has not been rebated or compensated on exports, and it's only applicable to explicit carbon prices, meaning you can only compensate carbon prices already paid in the country of origin if the country of origin applies a carbon tax or if it has a corresponding emissions trading scheme. That's what an explicit carbon price stands for. So if the country of origin, for example, were to be the US and you were to have a national regulatory measure that compensates for efficiency measures, for example, and you were able to draw a corresponding carbon price from that efficiency measure, the EU would not recognize that kind of pricing as a corresponding adjustment on origin towards the EU. And that's because it's very difficult to assess whenever you get into regulatory approaches, it's very difficult to find a corresponding price. You will probably have questions surrounding the methodologies employed to find that corresponding price. You would have to have agreement, for example, between the US and the EU that the methodology employed to draw the corresponding price is reasonable and it's acceptable. And, in general, in the international community, there is still ongoing debate as to what we consider to be a carbon price, outside the explicit carbon price. In fact, explicit carbon prices are pretty much agreed upon. It's emissions trading schemes and carbon taxes. And so the EU went the easy way and it just admits this reduction corresponding to a tax that has been already employed abroad. That's also deriving from WTO rules. So actually, there's a section there at the GATT that requires that level of compensation, so that importers are not subjected to a less favorable environment than domestic producers. And that's the rule of non-discrimination, and so that's what the rule stands for. There's a transition period, of course, as these rules would wave in slowly. It's still an ongoing debate. Like I said, it's going through the parliamentary procedure. Parliament and Council have co-decisions, so both have to agree on the rules, and both have presented new proposals that slightly change the original proposition coming from the Commission. The transitional rules apply between 2023 and 2025. The proposals that are ongoing suggest a shorter period of transition so that the rules would come into force faster. And the gradual phase in of the CBAM would be accompanied by a gradual phase out of the free allocation system under the EU emissions trading scheme. So basically, like Billy said, one of the objectives of a CBAM is to avoid carbon leakage. And it can, that objective can be achieved in several ways, one of which is through the adoption of a border carbon adjustment. Another one is the adoption of free allocations under emissions trading scheme. Both policies aim to fulfill the same purpose. So the idea of introducing a CBAM would be to have it introduced in order to slowly phase out free allowances under the emissions trading scheme, and consequently increase the domestic carbon price or the regional carbon price employed at EU level under the emissions trading scheme. And currently, most of the revenues would be allocated to the EU general budgets. Again, there is an ongoing debate there whether least developed countries should be exempted from the carbon border adjustment measure. I understand that in the US proposal, for example, they would, if they were to introduce a PCA. There are people that say that in order to support the principle of common but differentiated responsibilities, border carbon adjustment measures would have to contend for these least developed countries. But again, this is not established doctrine, and so there is still ongoing debate as to whether that would be the case. So these were just general remarks, and I'm happy to answer any questions.
So super, thanks. So Katrina, so you've spent a lot of effort trying to build the political coalition to enact a national carbon price in the United States, and sadly you have not succeeded yet. Still on the agenda, still in the works. And so my question for you, and this has already been touched on by the two previous speakers a bit, but in the absence of a national carbon price here in the US, does it still make sense to talk about a carbon border adjustment, or should we be talking about something else?
Yes, not yet. Thanks, Donald, and thank you for having me. It's a real pleasure to be with you today talking about this issue. We started the Center for Climate and Trade in February because we believe that we should be pursuing some form of border adjustment or carbon border adjustment mechanism or climate and trade policy more broadly, even in the absence of consensus about the domestic policy and the way forward. And I'll talk a bit about that. But first, let me say that the push is still alive for a border adjustment linked to a domestic carbon price. Billy talked about a proposal that Senator Whitehouse introduced last night with Senators Coons, Heinrich and Schatz, I have that right. And this would be an industrial sector focused border carbon adjustment linked to a domestic price component. A new approach to a domestic carbon price and border adjustment, keeping alive this idea that both should move together, because we know from the literature it's easiest to build a border carbon adjustment when the domestic policy regime answers some basic questions for you, like what is the carbon price, how do you measure the emissions as they move through the economy, etc. But it is more likely that we will see some form of border adjustment that is not linked to a domestic carbon price for a number of reasons. One is that there's increasing interest in the Senate for having some form of effort on climate and trade, most likely in the form of a climate club focused on like-minded economies in the G7, working together to address the emissions embodied in internationally traded goods. the House Republican Climate Task Force last week, 2 weeks ago, released a 6-part plan. And key parts of that plan are dedicated to beating China and Russia in international trade. One of the ways you can do that is by addressing the emissions embodied in internationally traded goods. And this White House is pursuing a half a dozen or so separate initiatives that reconcile trade policy and climate policy. One of them is the global arrangement on sustainable steel and aluminum that they're presently negotiating with counterparts in the European Union to replace the tariff rate quota system on those products. So things are moving, and it is extraordinarily important that we do figure out how to address the emissions embodied in internationally traded goods. Again, even before we have a domestic carbon price, because 25% of all global emissions are embodied in international trade. There are at present not policies to address that set of emissions. It's a set of emissions left out at the UNFCCC because we have a dedicated focus in that forum on domestic production emissions. And here we're talking about consumption. And the World Trade Organization is not going to be the starting point for creative thinking on how to address that emission set. So we have to address it. We also know that if the United States enacted trade policies so that imports had the same carbon intensity as domestic production, we would cut US emissions 600 million tons per year. If the US moved with other G7 countries to do the same, so we all had policies in place that reduce the carbon intensity of our imports, we would cut global emissions 1.8 billion tons per year, approaching 6% of global emissions just by accessing the emissions embodied in internationally traded goods. This is an indispensable part of a global climate solution. And then one last point, I think a substantial driver of the interest in uniting climate and trade policy is that we're learning now more about what we at the Climate Leadership Council call the US carbon advantage, which is that when we manufacture goods in the United States, we emit much fewer emissions than counterparts in other countries for a multitude of reasons. The energy or carbon intensity of our electricity grid, our capital markets, sort of like an innovation driver in the US because we care a whole lot about margins. But the global carbon intensity is on average 80% higher than US carbon intensity for production across the economy. China, India, Russia, 3 to 4 times the amount of carbon emissions to create the very same dollar of value as the United States. And we need a toolkit that allows the cleanest producers to benefit in international trade. If we do that, the US economy stands to benefit. We have done a study on one sector where we can get really good data. We're looking for more. If you have any tips on sectoral data, I'd love to hear it. But we studied the US steel sector. And if we had a domestic carbon price and a border carbon adjustment for the steel sector, we would cut imports in half, boost sales of US made product on the order of 10%, boost profits in the steel industry on the order of 40%. That is a climate policy making an incumbent carbon intensive industry more competitive. So this toolkit is really attractive. It also allows us to unlock really interesting co-benefits in terms of geopolitical realignment, a potent issue right now with Europe exploring the limits of its diplomatic response thanks to its dependency on Russian oil and gas, find new partnerships, new ways of connecting to emerging markets, facilitating decarbonization overseas with US innovative technologies. I mean, there's just a multitude of benefits that we can unlock now that we're focusing on this section of emissions embodied in internationally traded goods. So we should not wait for a carbon price to figure out how to move forward. Thanks.
Okay, so trade, super important. Just quickly for any of the panelists, was there anything that one of your co-panelists raised that you'd like to quickly comment on?
There was. So one of the things that Billy was talking about was this concept of carbon leakage, right? Where a regulatory or a price regime in one market will encourage import of competing products from overseas that might be less expensive because they can avoid carbon costs. So you squeeze a balloon and you just get more production somewhere else. But what we know based on studying the carbon intensity of production is that we're not just squeezing the balloon and displacing production and associated emissions. We're squeezing the balloon and increasing the associated emissions required to replace that production. So every time we send production to China, to India, to Russia, we are increasing the emissions associated with that production globally. We would be better off from a climate perspective if we manufacture more in markets like the US, like the European Union, that are much more carbon competitive in their manufacturing. We don't have tools to do that today.
So I'd like to pick up on an expression Billy raised, which I hope I'm quoting correctly, which is just again on this issue about doing border carbon adjustment in the absence of a national price. So I think the phrase you used, Billy, was tricky to dubious about ability to implement it. And particularly I wanted to ask Tatiana about that and about this intersection with the WTO and kind of from your perspective, how important is it to have a live national price? Or are there ways you think that a country like the United States could go down this route without that?
Right. So in order to have a border carbon adjustment to start with, you have to have a national carbon price. That's the number one rule, right? There are three ways in which you can have a domestic carbon price. Like I said, the concept of a carbon price hasn't actually been agreed upon yet, not even at the international organization level. But basically, from a border carbon adjustment perspective, there are three instruments you could use to have a carbon price. You could have a carbon tax, and that border carbon adjustment would be measured against the carbon tax that you employ domestically. You could have an emissions trading scheme, which is the example of the EU and the CBAM, which I have just mentioned. And then you could have a regulatory instrument, such as a command and control measure, or a measure that aims to increase efficiency. And that's the premise behind the United States Fair, Affordable, Innovative, and Resilient Transition and Competitive Act that you have enforced. For the carbon tax measure, actually, we have one proposal only existing globally, and that's the one that has been recently released in 2021 in Taiwan. So it would be a border carbon adjustment measured against the carbon tax. But to be consistent, so that's the premise under WTO law, the General Agreement on Trade and Tariffs. It basically provides for three non-discrimination rules. The first rule is the most favored nation rule, which says that basically that benefits granted to one member must be extended to all members. So basically parity of treatment between all members. National treatments, that one obligates signatories to grant foreign products the same treatments that a national product would receive. Again, non-discrimination. And then there are quantitative restrictions that basically says that rule says that imported products should not be subjected to a more burdensome regulatory requirement than like domestic products, because what countries have done in the past is they wouldn't employ a tariff per se or a price measure at the border, but they would make extremely burdensome regulatory requirements at the border, which would be commensurate with the application of a price. Basically, if you look at it from a legal perspective, and all issues considered, you'll see that a border carbon adjustment basically fails those three tests. But then you fall into another rule, which is a public policy exception under the GATT. And that public policy exception basically says that measures that are restrictive of trades may be justifiable if they are related to the conservation of an exhaustible natural resource, provided that it is made effective in conjunction with restrictions on domestic production and consumption. So broadly, any measure, a border carbon adjustment measure, would probably fit into that public policy exception, all issues considered under WTO law, because you have a previous precedent under a case called US Gasoline that recognizes that clean air is an exhaustible natural resource under the terms of Article 20G, which is this public policy exception. The question then is whether every single instrument of carbon pricing, so whether carbon taxes, ETSs, and regulatory measures could all fit into that public policy exception, because what we do legally is we look at the jurisprudence and we try to exacerbate it to try to include other instruments to see whether they would fit into the rationale of the appellate body. And looking at it, what we can say is that, well, the rationale was applied towards a measure it's a taxing measure. So a carbon tax, so if a country employs a domestic carbon tax, its corresponding border carbon adjustment would probably fit within the description of the GATT, and it would probably be consistent with WTO rules. For emissions trading scheme, it's slightly different, because an emissions trading scheme, despite trying to pursue the same objective of a tax, is not actually a tax. It's a price, a regulatory measure. And actually, the EU, for domestic reasons, also says that their CBAM, their carbon border adjustment mechanism, is not to be comparable to a tax. It's to be considered to be an economic regulatory measure, under the words of the Commission. That's super significant for domestic purposes within the EU, because it means then that the rules that they establish are not subject to unanimity within the EU. They're subjected, upon voting, they're only subjected to qualified majority voting. But for WTO purposes, that might be problematic, because it means that the ETS the CBAM that is compared to the emissions trading scheme employed domestically wouldn't be comparable to a tax. So we wouldn't, even though, you know, under all assessments from a literature perspective, you would consider it to be, it wouldn't be under their assessment comparable to a tax, and therefore it would be questionable whether it would fit within the jurisprudence of the WTO as it stands now, without a new procedure to question that CBAM.
Oh, so is it fair to say that all of us are on a trajectory now where we may have WTO issues then?
Yes, by all means, yes.
Okay.
And especially if you have a regulatory measure, because then if you have a regulatory measure as a basis, as is proposed in the US, then you really have absolutely no grounds to support that type of measure. A CBAM that is compared to a regulatory measure would be acceptable under the WTO rules. Right.
Okay, so that will be a pressure point in the future. So Billy, oh, go ahead, yeah.
I didn't want to preempt what I'm curious what you wanted to say. I did want to just clarify two things from Tatiana's comments, which I largely agree with. You know, one is, I think, you know, we might want to distinguish between different types of regulation. Like, for example, if the United States had a regulation in the steel industry, which basically required set a maximum emission rate per ton of steel, then you might imagine that is, you know, equivalent to, you know, an infinite price on any emissions that are above that level for steel plants in the United States. And with that kind of regulation, it might be much easier to think about border measures that would mimic, I mean, they could just limit imports to be imports that meet that benchmark, or maybe there's a penalty for emissions above the benchmark. So I think there are some regulations that might be easier to think about in terms of what a border measure might look like. I think what's much harder is when you have kind of a collection of other regulations that aren't really that specific. They may not even be directed at carbon dioxide and other greenhouse gases. And that's where I think it goes from difficult to dubious, because I think it's very hard to guess what that looks like. The other thing I just wanted to highlight is that traditional regulation doesn't look like the kind of border measure that most countries are, I think we tend to think about. Usually you think about just taxing emissions of imported products. And if you have a domestic regulation that basically allows you to emit up to a certain point and then you run into trouble, what you really want to think about are border measures that similarly allow you to emit up to a certain point and then begin to penalize you when you're above that point. So I do think it's important to, you know, be thinking about border measures that, you know, are attempting to mimic the regulation of domestic industries. That's not to say these things are not going to run into problems with the WTO. I'm not a lawyer or that knowledgeable about WTO, but the principle that we've been trying to think about at RFF and like our writing and our issue briefs, and I think is reflected in the White House bill, is this notion that you should be thinking about imports in the same way you're thinking about domestic production. That doesn't totally get you out of the WTO trouble, but at least I think gives you a better angle towards success.
Yeah, go ahead, Tatiana. Yeah.
If I could just complement that, just to get back to the CBAM proposal, you remember that I said that it was based on actual emissions that are measured in the country of origin. And that's another issue as well from a WTO perspective, because of course, what you see always with the General Agreement on Trade and Tariffs is that the treatment applied at the border has to be consistent with the treatment that is employed domestically. So you're always looking into the domestic market to find the standard of comparability. You're not looking at another country to find that standard of comparability. Now, when the CBAM was proposed, what it says in the legislation is that you will look into the foreign country. So you will look into the country of origin to see what the actual emissions were, and then eventually apply a deduction if there is a corresponding carbon price being applied in the country. So the fact that the corresponding price is in respect of a product that was produced abroad and the emissions are corresponding to those emissions that were released in the foreign country is an issue as well from a WTO perspective.
And so,
May I just add some color? So this conversation has been driven so far by ensuring that the border adjustment is consistent with climate policy. It's coming from a climate policy space. And one of the things I've been learning as we talk more and more about the connection between climate and trade is that a solution set that starts in the trade space looks much different. So we have three co-chairs at the Center for Climate and Trade. One of them, Jennifer Hillman, former International Trade Commissioner, also former member of the WTO appellate body. She encourages us to think creatively, because it is her opinion that the World Trade Organization does not want to stand in the way of using international trade mechanisms to reduce the carbon intensity of global trade. The World Trade Organization wants to be relevant. It does not want to impede global climate solutions. Another one of our co-chairs at the center is Ambassador Charlene Barshevsky, former US Trade Representative. And her perspective is rooted in, rooting for the US and for free trade. And she sees a lot of opportunity in building climate considerations into trade agreements. Every time we do a trade agreement, there's something about environment in there, and we can continue to build on that. I've heard a lot of folks from the trade space talk about how the vast majority of existing tariffs are entirely arbitrary, and that it's not inconsistent to think about using arbitrary tariffs at the border to address climate also. And that means imposing policies that care a whole lot about the carbon intensity of production at the border. So we do want to price actual emissions as they occurred overseas, but we shouldn't care so much about it being connected to a domestic climate policy or a domestic carbon price explicitly, because we already have terrific emissions performance in the US market, and we want to encourage better emissions performance from imports as well. So I just want to widen our lens a little bit to also consider this from the trade perspective. And a lot of trade folks, especially former trade negotiators for the US, so you can imagine their lens, are less concerned about having climate and trade policies being directly tied to domestic decarbonization efforts because they're more comfortable being a bit arbitrary in the price rate set at the border, as long as we're approaching the right set of emissions.
So this conversation is raising for me an ill-formed possibly question, but just there's a set of things you can imagine a country doing unilaterally, treating the EU here for purposes as a country, right? So an economy can do unilaterally. There are things you might do bilaterally through a trade agreement. There are things you might do multilaterally by creating some sort of carbon club. And then, of course, on the economist's whiteboard, the answer to all of this is globally, to have a global carbon price, since it's truly a global externality and global challenge. And I guess my question for any of you and all of you is sort of how do we think about the unilateral versus the multilateral? Like if the EU goes ahead with its proposal, should we worry that that's going to have negative effects on the US? If we do something multilateral, should we worry about who's in the club and who's out of the club?
So can I have a first go?
Sure.
So I think the short answer to your question is yes. I think initially there might be unintended consequences towards countries that do not apply a domestic carbon price. But I think that's also one of the objectives of the EU, and as it stated.
I'm sorry to interrupt. Just to be clear, that was a euphemism for the United States, right?
Yes. In the US, in the US or in any other country that doesn't have a carbon price, because you have to think. Of course, you think about it unilaterally. You have a CBAM in the EU, and that's what they're doing now. But it is really a global issue. So any type of approach or agreement towards a climate club type of approach, and you have several proposals that are out there to consider a climate club, one coming out of Germany, one out of the IMF, discussion paper for a common carbon price. Any such type of approach would have to be an agreement between all countries that are interested in employing a border carbon adjustment and adopting a minimum carbon price domestically, one that is suitable for that climate club. And that will obviously have an impact in third countries that do not have a corresponding carbon price. So the CBAM automatically creates a kind of incentive for countries that do not employ a carbon price to do so. Why? Because if you think of it from a tax perspective, for example, let's say a country that that does not have a carbon tax or an emissions trading scheme, such as the one that is recognized under the EU CBAM, what the EU is doing is saying, if you do not employ a corresponding explicit carbon price, we will tax it for you to start with, and we'll keep the revenues. So by not employing a domestic carbon price, you're actually dislocating the potential to generate revenues in a foreign country and sending that right, so to speak. It's not an acquired right, it's a taken right. So the EU is saying, if you're not do it, I will do it for you, and I will keep the revenues associated with it. And I think in a post-recessionary environment, such as the COVID environment that we are living through, I think that's a very strong point. In many countries, especially these developed countries and middle-income countries, are considering the introduction of domestic carbon prices because they don't want to have their resources mobilized elsewhere. So they don't have the deviation of their potential tax revenues to a different jurisdiction.
Okay, so in short, right, unilateral action can spark multilateral interaction through the incentives it creates, potentially.
Yes.
Does that sound, Billy, go ahead.
Yeah, I just wanted to elaborate a couple of things, which I think Tatiana was hitting on. Fundamentally in my mind, border measures, we had this conversation like 10 years ago when the United States was considering the Waxman-Markey bill, and there was a lot of pressure to include border measures there. And I don't know how much pressure there was, at the beginning of the EU ETS to include border measures from the start. But, I think border measures are something that become important as you have higher ambition. And, I think it was maybe Katrina who was mentioning that, the industrial sector is 25% of emissions. We're now talking about net zero emissions in the next, few decades. We have to tackle the industrial sector in a way that maybe we weren't thinking about it quite as ambitiously 20 years ago. So there's a tension between the countries that want to go, quickly, the EU being at the top of the list right now, but maybe the United States one day. And there has to be a way of tackling this emission leakage and this competitiveness issue that arises in the industrial sector. So I think there's a tension that exists between, on the one hand, allowing ambitious countries to move forward without these adverse consequences, and recognizing that border measures and things like this, tend to make the recipient countries unhappy. And I think we also have to be aware that for a lot of countries, the incentive may be, somewhat limited. There has been economic analysis of how much of a financial incentive it actually sets up for countries to try to avoid the tax on their import or their exports to another country. I think in a lot of cases, it may have to do with, close neighbors. When the United States was talking about a carbon price, Mexico and Canada were being very attentive, and I imagine the EU trading partners, the strong trading partners, would be similarly very attentive. But I think the third thing I would just mention is that one of the things that motivated at least us, when we were writing about this prior to the White House proposal, was the idea that, to the extent you're going to have industrial sector decarbonization, first try to minimize the impact on trade. So the idea of having benchmarks where you're not pricing the emissions up to the benchmark, reduces the amount of trade distortion that happens in the first place, and it limits the volume of the border measure you need because you're only taxing the emissions above the benchmark. So I think, thinking about ways to minimize the adverse consequences, where possible to try to create the multilateral opportunities for expansion, but just to recognize that, the history of developing multilateral climate solutions has been very slow. So I think, we have to proceed with the idea that there's going to be singular countries or a small number of countries that are leading.
I totally agree with Tatiana and Billy that this is going to start with a handful of countries out in front. We have heard from all G7 members interest in something related to climate and trade. Heard similar interest from South Korea. It seems like Australia is hot on the case here. So without a doubt, the sort of first step is going to be unilateral or bilateral. There's a chance that the US-EU steel and aluminum arrangement goes into place first, which is also a climate and trade policy, potentially a border carbon adjustment. But the ultimate destination does have to be a multilateral arrangement, multilateral in the diplomatic sense, not the World Trade Organization sense, would require all members, because that is the best way to address emissions reductions. We do have to partner together to access the emissions embodied in internationally traded goods. And we can consider the value of these climate and trade relationships that start in something like a border carbon adjustment for facilitating trade and things we want to see more of out in the world. So it's not just accountability for carbon emissions as imports come into your economy. It's using your trade policy to ensure that more decarbonization consistent technologies and innovations get taken up in emerging markets, in partner countries, so that we can actually achieve decarbonization at the scale and speed necessary, which is not inevitable. It does require substantive policy change. It will require leadership from climate ambitious countries to pull others along. So I believe the destination has to be multilateral arrangements. And we see a whole lot of interest in that in the US Senate today. The White House proposal that came out last night gives sort of another negotiating position for the United States as the European Union considers CBAM. There's the Coons-Peters proposal, the FAIR Act that Tatiana has invoked a couple of times in this conversation. There's all of the things that the administration is presently doing on climate and trade. So there's a lot of interest in spurring these multilateral arrangements because we see high potential benefits for decarbonization and for the US economy.
And so quick political question, both for the US and for the EU, like if you look across industries or categories of advocates and people, like who is most in favor of carbon border adjustments and who is the most skeptical or concerned about them?
Well, I mean, I think, we've talked about this a little bit, but, you see, in some ways there's a coalition, and I think that's what White House is actually trying to tap into, that there are, more traditional conservative folks who are very excited about trying to capitalize on the carbon advantage that US industries have right now that currently is going, in some sense, unexploited. And meanwhile, you have people who are very concerned about decarbonizing industry, wanting to tackle emissions in this sector. So, the question is, can you build a coalition that would, be interested in both? Now, when White House was talking this morning about his bill, he was pretty explicit that his goal right now is he doesn't feel like you could get, the 10 or 12 senators you need on the Republican side to pass the bill with bipartisan support. So his approach right now is to try to do this through reconciliation, which is why he introduced it now and why he's trying to go down the directions he's going. So, while I think there is broad support, and maybe there's a bipartisan approach, in the offing that would come down this way in the United States, right now, at least his view is that it is going kind of, down the reconciliation approach. I don't know if that totally exactly answers your question.
And just like in terms of industries, like, is there particular clamoring?
Oh, yeah. There's, the event today had someone from the cement industry. I think a lot of these industries recognize the potential value in some sense of monetizing what is, currently an unmonetized advantage. So we'll see what happens after it's been dropped, but there certainly are indications that there are, members of these industries that would come out in favor of it.
Yeah, I don't think that there's sort of any industry that has a unanimous position on border adjustments or climate and trade policies broadly, but there's a lot of reason to see industry interest here. There are leaders in this space from industry clamoring for some ability to at minimum be able to measure and compare the emissions associated with their goods, and preferably have a sort of price-based incentive to favor lower carbon goods. But the US and EU Global Arrangement on Sustainable Steel and Aluminum introduced the idea that you can also use accounting for the carbon intensity of traded product as a lever to address particularly Chinese oversupply in the industry. Chinese oversupply is a drag on very many energy-intensive industries in the United States. And now we see the potential for border adjustment measures to play a key role in fighting that overcapacity and allowing industries to compete based on desired production and not just sort of politically directed production in foreign markets.
And Tatiana, how does the politics look in the EU? Like, who's in favor, who's against?
No, you would expect. I mean, the national industry seem to be going hand in hand with the CBAM policy, because of course for them it makes sense if they're already paying a domestic carbon price through the negotiation of permits at the emissions trading scheme. They would want to have the importer pay for the same price as they do. An alternative measure that is also considered in that framework. I mean, this is all ongoing discussion, right? So there's still room for change in the original proposal of the Commission. Would be to consider an export border carbon adjustments, and that would be in a nutshell, it would be the elimination of whatever price was employed on imports or under the emissions trading scheme, so that the product is then exported with a zero cost, so zero additional costs in terms of environmental emissions. It's from an environmental perspective, it's not a desirable policy because of course you're basically imposing a price to start with, and then you're detracting from that price. And so it's a neutral position. You don't have any gains. There are no gains to be had from an environmental perspective. But from a business perspective, so from the perspective of the industries that are affected by the policy, it's probably a desirable policy because they get to trade their products at parity of price and at competitive prices under the international markets. So which policy will be employed ultimately? It's a question that is still open for consideration. I don't think they will go the export border carbon adjustment way. I think that they will ultimately, the objective is actually to have a positive price employed on emissions. So I think industries are actually not lobbying too hardly against it. What they want is just to be subjected to one price and really to avoid double taxation, to speak, so to speak, so that they are not charged twice on the same emissions. But other than that, I think the environment seems to be receptive of the policy.
Mm-hmm. And Katrina and Billy, I'd appreciate your thoughts on this issue about the imports and the exports, right? So if you asked me to naively go to my whiteboard and write down a naive carbon border adjustment, it would have this feature of having a tariff on imports and a rebate on exports. Is that what we should be aiming for? Is that what the world's going to aim for? Or is there really a significant difference, either politically or economically or environmentally, in your view, between the imports and the exports?
Well, I mean, you could go to your whiteboard and you could show that, excuse me, having a border measure that taxes imports like unambiguously lowers global emissions.
Mhm.
And you would see that subsidizing exports has an ambiguous effect on emissions because it's a trade-off, because you're not getting as much leakage to other manufacturers in foreign countries that are unregulated, but you're also not pushing emissions down as much domestically, and it could go either way. So, the environmental argument for the export rebate is not as compelling, but from a competitiveness standpoint, it certainly is. And in the White House proposal, they are rather explicit about the export measure. I mean, the other thing that's been proposed, and this is another thing that's been put out by some folks at RFF, Jan Marys and Brian Flannery, is the idea that every country would actually do the same thing, that every country would tax its imports and subsidize its exports, and then you wouldn't need the clubs, because basically the goods would simply move, from the European carbon price, which would get rebated at the border, to the US carbon price that would get taxed when it comes into the United States. So there is kind of a system that you could imagine working that would have that whole combination globally. But the other approach would be to try to encourage clubs of countries just to have a common border measure and to try to use that as a incentive, I think, as Katrina was saying, to grow the club of people that are doing this.
Yeah, I'll echo what Billy said. Unambiguous climate benefit to pricing the emissions associated with imports, potentially ambiguous climate benefit to rolling the price back on exports. Although I'll say that if we're exporting the average product and our average product is cleaner than what it might displace in international markets, that would be a net benefit to the global climate. But I think more broadly, it's about thinking what we want the basis of this policy to be. Are we pricing domestic consumption emissions, or are we pricing every last ton of emissions that the United States can get its hands on? Those are two different lenses to view a policy. And I think a robust price that's placed on imports and removed from exports seems much more in line with how the US is inclined to think about climate policy, which is to make sure that we are decarbonizing our own supply chains, decarbonizing our own economy, and then allowing our cleaner production to compete on a level playing field abroad. The dynamic shifts somewhat as we approach a sort of critical mass climate club, but those exercises are theoretical at this point. So maybe we can leave that for a future discussion when we've handled this early stage of climate and trade policy.
And so we're almost out of time here, but this may or may not be a fair question, but sort of, to an economist, right, the global optimal solution is, uniform substantial carbon price, right? The world is not cooperating in adopting that. Naively, back on my naive whiteboard, you could ask the question, wow, if countries are able to get together and form a carbon club, maybe they could get together and just all agree on national carbon prices and harmonize them that way. But I think what I'm hearing is sort of a story of, politics is the art of the possible, and that's not possible, but that trade measures are a lever we can pull on. Trade is important. As you move from carbon price to trade measures, I think I heard early on there's some issues of feasibility, right? It starts getting complicated about what the data are and how you measure things and whatnot. But so is the way I should think about this is that kind of the focus on carbon border adjustment is trying to find kind of a universe of goods where it's approximately feasible to do this. And then the politics say that this is something that we might be able to make progress on. Like, is that a fair way to frame it?
I think you've asked two questions here. So starting with sectoral arrangements, I think could be really beneficial. Again, that US-EU steel aluminum arrangement is a good starting point. International commodity agreements are allowable under the GATT. It's the Article 20H exception. We might be seeing a proliferation of these. It doesn't address the supply chain issues that Billy was invoking earlier. So what happens to the cost of a car? Mm-hmm. But I think more broadly, if we want to think about club membership, the key about policy comparability is not that we have the same price as our partners in a club, it's that we have comparable effectiveness in the policies that each of us select. And that's a way different measure, much more difficult to whiteboard about than a harmonized carbon price, but it is the goal here, that the cumulative impact of domestic policy choices are comparable within the club.
Yeah, I think totally right. I mean, I think the I certainly started 20 years ago or 30 years ago thinking that the global agreement on a carbon price was the ideal, and that's what we should work towards. And I think there's two issues that I think kind of conspire to make that unlikely. One is just the politics of getting countries to agree and to stick with it, given their conflicting domestic needs. And the other is recognizing that as we go towards decarbonization and getting zero emissions, some of the advantages of carbon pricing actually go away. Like, you don't really need to worry about pricing the emissions that are occurring if ultimately what you're really trying to do is get rid of all the emissions. And I think thinking about the practical ways forward in the places where we can move forward is just super important. And in this kind of critical area of industry, it turns out that you just cannot make progress without thinking about trade. And I think the question is what are the set of practical policies that you can move forward with in this sector? And it seems like right now, whereas 10 years ago, I might have been very worried about trying to go down this border measure route and the complexity of doing these calculations. There's been a lot of work done on this over the past 10 years. And the sectors themselves have been doing a lot of work in terms of thinking how you could do this practically. And I think there's a lot more optimism that we could do this and that this is what we have to do. And so I think we're just in a different place.
Great, thanks. Well, so we've reached our time, and so I guess it's good to end on that slight note of optimism there. So Katrina, Billy, Tatiana, want to thank you for being part of this panel. And more broadly, want to thank everybody who's participated in today's conference. Obviously, taxation is a global phenomenon. It has spillover effects on the rest of the world. And so while US discussions are sometimes a little parochial, it's great to have a discussion today that thinks about the rest of the world. And so thank you everybody for attending.
Thank you.
Thanks for having me. Go Tar Heels.